Hello everyone. The foreign exchange market is a highly sensitive market where a single news item can rapidly change currencies worldwide. Rather than simply judging whether currencies are currently rising or falling, it is crucial to deeply analyze what variables will move the market over the next 2 weeks. In this analysis, we will comprehensively cover the policy directions of major central banks, global economic indicators, and the movements of institutional investors. Chapter 1. The Bank of Japan, a key variable in the foreign exchange market. The key variable that will most significantly move the foreign exchange market over the next 2 weeks is undoubtedly Japan. Looking at recent statements from Bank of Japan officials, their willingness to raise interest rates further is very strong. According to a recent economic media report, voices supporting a January rate hike have exceeded a majority within the Bank of Japan's policy board. It is projected that more than 5 out of 9 policy members will support a rate increase. Japan's current benchmark interest rate is 0.5%. If the Bank of Japan raises rates by an additional 0.5% in January, this would be the first time since February 2007, approximately 18 years ago. For Japan, which has maintained an ultra-low interest rate policy for the past 30 years, this represents a truly groundbreaking change. So why is the Bank of Japan rushing to raise interest rates? The biggest reason is yen weakness. Recently, the yen-dollar exchange rate rose to the 158 yen range, recording the lowest yen value in about 5 months. When the yen weakens, import prices rise, which in turn leads to inflationary pressure within Japan. In fact, Japan's consumer price index, excluding fresh food, has exceeded the 2% target for 28 consecutive months through November. Particularly, the services price inflation rate that the Bank of Japan is focusing on has maintained a solid level, recording 1.5% for consecutive months in October and November. This shows that structural price increases are progressing along with wage increases within the Japanese economy. Bank of Japan Governor Kazuo Ueda recently pointed out that the impact of exchange rates on prices is becoming larger than before in some cases. This is interpreted as a strong signal that the Bank of Japan will no longer tolerate yen weakness. While yen weakness was previously perceived as favorable for Japanese export companies, the judgment now is that the side effects of import inflation are greater. Policy Board member Junko Nakagawa stated last week that prices are showing a relatively strong trend, so we need to continue raising real interest rates. Another board member, Kazuyuki Masu, also mentioned that the timing of a rate hike is imminent. All these statements are factors increasing the possibility of a January rate hike. Experts see 2025 as a very important year for the Bank of Japan. This is because there is a high possibility that 2025 will be a historic year when the Bank of Japan raises the benchmark interest rate to levels not seen in Japan for the past 30 years. Some experts even forecast that the benchmark rate could rise to 0.75% or 1% during 2025. Under these circumstances, the yen is expected to show very high volatility over the next 2 weeks. A single statement from the Bank of Japan or a single release of Japan's consumer price index could create sudden movements of 200 to 300 pips in yen-related currency pairs. In particular, yen pairs such as USD/JPY, EUR/JPY, AUD/JPY, and GBP/JPY are highly likely to show a rollercoaster flow of short-term strength followed by sudden government intervention, then correction, and another attempt at strength. This is both a risk and an opportunity for investors. Chapter 2. US Dollar and Major Currency Outlook. The US dollar has shown strength over the past few months. However, the outlook going forward is different. The Federal Reserve is no longer considering additional interest rate hikes. Instead, the possibility of rate cuts is gradually increasing as employment slowdown, US economic growth deceleration, and inflation reduction are all coming together. According to recent market expert analysis, the Federal Reserve is expected to cut the benchmark rate about twice in 2025, from the current 4.25 to 4.5%. This means rates could fall to around 3.9% by year end. This is significantly reduced from the 4 cuts suggested in the September forecast. Federal Reserve Chairman Jerome Powell recently took a cautious stance, stating that a December rate cut is not a done deal. However, he also emphasized that the risk of employment weakening is growing. What does this mean? While the dollar may rebound in the short term, there is a high possibility of weakness in the medium term. In fact, looking at the CME FedWatch indicator, the probability of a rate cut at the December Federal Open Market Committee meeting has risen to 71%. Although opinions within the Federal Reserve are divided over rate cuts, the overall trend is toward easing. However, the pace of cuts appears slower than initially expected. The euro currently faces difficulty finding clear upward momentum. The European Central Bank has recently been strengthening its dovish stance. This is because the possibility of additional rate cuts is being raised as Eurozone inflation eases. Combined with growth slowdown concerns, the euro is under downward pressure. In particular, Germany's economic recession is burdening the entire Eurozone. Although Germany is the Eurozone's largest economy, growth rates have stagnated due to continued manufacturing weakness. This acts as a negative factor for the euro. The British pound faces a similar situation. Policy uncertainty has increased since the recent announcement of the UK government's budget. The pound is likely to show additional weakness, along with the possibility of Bank of England rate cuts. The UK economy has been experiencing structural difficulties since Brexit, which forms the long-term background for pound weakness. China's economic indicators must also be closely watched. If China's manufacturing PMI comes out weak, the Australian dollar and New Zealand dollar will immediately face downward pressure. The Australian dollar in particular reacts very sensitively to 3 factors: Chinese economic indicators, commodity prices, and risk sentiment. While there is a possibility that the Chinese government will announce stimulus measures, their effectiveness is expected to be limited. This is because China's structural economic problems are difficult to solve with short-term stimulus measures. Over the next 2 weeks, the Australian dollar is likely to continue its weakness. The New Zealand dollar is expected to show relatively stable performance compared to other risk currencies. This is because the Reserve Bank of New Zealand's policy is maintaining relatively consistent direction. In particular, the New Zealand dollar against the yen is expected to show relative strength. Chapter 3: Investment Strategy and Risk Management. The foreign exchange market will show high volatility over the next 2 weeks. Overall, a safe asset-centered flow is expected to be maintained, with news from the Bank of Japan and the Federal Reserve leading the market. Summarizing currency strength and weakness. The yen has the highest volatility. Long positions, bounce trading, and short-term swing strategies are most advantageous. The US dollar shows short-term rebound followed by medium-term weakness. Both long and short positions are possible, but indiscriminate chasing is prohibited. The New Zealand dollar shows a stable rebound flow. A strength strategy against the yen is effective. The euro and pound are expected to maintain weakness. There are opportunities in short strategies. The Australian dollar has no upward catalysts for some time. Short strategies have the advantage. Let's examine specific investment instruments. First, USD/JPY buy strategy. Entry range is between 153.80 and 154.30. Target is 156.70. to 157.40. Stop loss is 152.70. The win rate is expected to be about 71%. Even with dollar weakness, the yen will move more strongly, and rebound opportunities will repeat due to Bank of Japan rate uncertainty. This strategy is suitable for short-term swing trading, and volatility is expected to increase whenever Bank of Japan statements emerge. Second, NZD JPY buy strategy. Entry range is between 89.30 and 89.70. Target is 91.20. Stop loss is 88.50. The win rate is expected to be about 68%. The New Zealand dollar is the most stable among risk currencies, and long swings are advantageous during yen overreaction periods. This currency pair is suitable for investors seeking relatively stable returns. Third, GBP USD sell strategy. Entry range is between 1.3120 and 1.3160. Target is 1.3020. Stop loss is 1.3200. The win rate is expected to be about 64%. Pound weakness is expected as UK policy uncertainty combines with short-term dollar strength. As long as structural problems in the UK economy continue, pound weakness pressure will persist. Fourth, AUD/USD sell strategy. Entry range is between 0.6460 and 0.6490. Target is 0.6380. Stop loss is 0.6510. The win rate is expected to be about 62%. Chinese economic slowdown concerns will negatively impact the Australian dollar. Commodity prices are also likely to weaken, acting as a double negative for the Australian dollar. Finally, let's review risk factors. A single word from the Bank of Japan can significantly shake the market. In particular, statements from Governor Ueda or key policy members will trigger immediate market reactions. The intensity of the Federal Reserve's rate cut language is also important. Chairman Powell's press conference content must be carefully analyzed. China's manufacturing, PMI, and whether stimulus measures are announced should also be monitored. Chinese government policy announcements directly affect the Australian and New Zealand dollars. The possibility of Eurozone economic warnings and UK political risks are also variables. And we must prepare for volatility explosions before the US non-farm payrolls release. Typically, market volatility sharply increases 3 to 5 days before the non-farm payrolls announcement. Considering all these factors, it is safe to maintain investment weight below 40% and always set stop losses. Even amid extremely high volatility, there are sufficient profit opportunities if you identify accurate entry points. Over the next 2 weeks, the Bank of Japan's movements must be closely observed. If the January rate hike becomes reality, it will cause major ripples not only in the yen, but in the entire foreign exchange market. The Federal Reserve's December meeting results will also be an important variable. The most important thing in investing is risk management. No matter how good a strategy is, without stop losses, a single mistake can lose everything. Always set stop losses and appropriately manage investment weight. Also, it is safe to keep leverage as low as possible. During periods of high volatility, you must avoid emotional trading and stick to principles. Strictly adhere to planned entry and exit points. When the market moves differently than expected, it is wise to boldly cut losses and wait for the next opportunity. I hope today's analysis provides practical help for your investments. Thank you.